Hello and welcome, everybody. I'm Vern Cushenberry, and I'm back with another quarterly market update. This quarter was a little mixed. Domestic stocks were up, international stocks were down a bit. Fixed income was split between international and domestic. So, for your typical retirement plan investor that has a healthy mix of international, domestic, fixed income, returns were flat, maybe just a little bit down. I always try to give my audience the bottom line up front, which is that there's nothing about these returns that stands out. And I'm sure my audience right now is saying, well, hey, wait a minute, Vern. We had a pretty big election this quarter. And yes, we did have a pretty big election this quarter. And the market has taken that in stride. I went back and I looked at the last time President Trump was elected. That would have been 2016. And from the election to the end of the year, the market was up about 5%. And that's almost exactly what we saw this time around. The bounce was in about the same range. So the markets, for one, are interpreting his policies as a positive thing for business and as a positive thing for business earnings. And there will be a lot more to examine as we move forward. And I've had a lot of question about tariffs, and tariffs are a tool. And there is some danger that if we implement tariffs as a country, that could ignite a trade war. And trade wars are inflationary. So we need to take measure of how aggressively the administration is going to use a tool like tariffs before we can come to any conclusions about where that's likely to take the markets. So more to come on that. I don't have anything conclusive to share as of yet. Long term, the market is almost all green. You can see here that 1, 5, 10, 15, and 20, all markets are doing what they typically do for investors, which is compound investor capital over time. And this is really the power of patience. And if there's one message I can leave my audience with every quarter, it's the power of patience. Let's take a deeper dive into what happened in the last year. If we look underneath the hood a little bit, we can see that the market was led by communications and technology, up over 35%, both of those sectors, which is really very, very strong. And I've shared this data in the past. I've mentioned something called the Magnificent Seven. The Magnificent Seven includes Apple, Amazon, Google, Meta, Facebook, Microsoft, NVIDIA, and Tesla. So if we just look at those 7 stocks, we see the core of the leadership for all of last year's returns. And if you look up at this box in the top left-hand side of this chart, you can see the returns to the Magnificent Seven going back from 21, 22, 23, and 24. Let's just look at the 24 column there. And you can see that the returns to those 7 averaged 48%. Compare that to the returns to the S&P 500, which were 23% last year. And if we subtract out the returns for the Magnificent Seven, we see that the S&P 500 returned 10%. 10% is actually on par with the long-term historical average. So the leadership was really, really concentrated. Now, why is that? Well, the market is very, very excited right now about opportunities that are surrounding and converging that include artificial intelligence, machine learning, robotics, optics. One that's really captured my attention lately is nuclear fusion, some of the advances that we're making. The markets are a little bit pricey right now. If we look at price to earnings ratios over the last 20, 30, 40 years, we see that the markets look a little bit expensive. But if there's a future on the horizon where we can solve for cheap energy, well, then these prices don't look expensive to me at all. Now, that's a future that we can't yet see, but I think everybody can experience in their own daily lives that the pace of technology is accelerating significantly. And that's kind of what this chart here shows. If you look at the left-hand side, what we're tracking is capital expenditures. So these are investments that are forecast. They haven't happened yet, but you can see what has happened in the darker gray bars. These are billions of dollars of investments that our leading technology firms have made going back to 2004. So you can see that between 2004 and 2024, capital expenditures increased from $2 billion a year to last year's $126 billion. And in the next 3 years, those investments should total over $500 billion. Now, what's that mean for our economy? Well, that could mean increases in productivity gains across all industrial sectors that make this one of the greatest investing opportunities of our lifetime. Now, time out, dial that back a little bit. I always try to look at this with a level head, and that's the optimistic scenario. The pessimistic scenario is that this is an environment that leads to overinvestment, like we saw in the tech bubble of 99, 2000, 2001. And the tech sector, especially, goes through a protracted bear market. Now, the silver lining there is that in the tech bubble of the early 2000s, overinvestment laid some of the infrastructure that led to 2 decades of significant growth for our economy. So there's a lot going on there, a lot more to come. I wanted to point out that I sift through probably 100 slides every quarter, and I cherry pick 2 or 3 that catch my attention because that's what I'm interested in as a portfolio manager. And I try to share it with our audience in a way that hopefully instills confidence and hopefully gives you some insights into what's driving the returns to your portfolio. But as always, I try to wrap that up and bring it back to some long-term investment wisdom and truths so that we can put that into perspective. And I cut this chart this quarter, which I thought was meaningful. When we look at the Magnificent Seven, let's just talk about the largest 10 stocks in the S&P 500, or the largest 10 stocks in the market. Dimensional Funds put this slide out. I thought it was terrific. And it tracks the returns to those largest 10 stocks before and after they appear on the largest 10 list. And this won't surprise anybody. This is the old adage, you want to buy low and sell high. Well, by the time you end up on the largest 10 list, you're high. So if we look at the returns to the largest 10 before they show up on that list, you can see prior 10-year returns at 11, prior 5-year returns at 20, and prior 3-year returns at 27. Now, draw a line in the sand and track those same returns subsequent to their appearance on the largest 10 list. And what you see is that subsequent to that line of demarcation, the next 3 years, those stocks return 0.5%. The next 5 years, they return negative, call it 0.1%. And the next 10 years, they return negative 0.15%. So there's a lot of excitement. There's a lot of euphoria for the Magnificent Seven. This chart just causes us to take pause and revisit the notion that, yes, we are trying to buy low and sell high. So how do we do that? Well, we do that with disciplined rebalancing. And when we look at disciplined rebalancing, what we're observing inside of our portfolios now is that we're selling those higher priced securities and we're buying the lower priced securities consistently every quarter. And some of those lower priced securities right now represent the fixed income market. And we know that because we can look at real yields. That's what I look at as a portfolio manager, is real yields, which is the yield that you typically see printed in the newspaper, less inflation. So that's what is really happening at the household level. That's the percentage change in the amount of stuff that you get to buy quarter to quarter. And the real yields right now, if we look at the 10-year Treasury, are at 1.9%. We haven't seen that level since January of 15. And when we isolate those real returns and look at how bonds have done in those similar environments over time, we can see that they average 8.1%. And it's the rebalancing that naturally takes that into account and captures those returns inside of our portfolio in a way that lowers the overall risk to your portfolio and to your financial plan, and ultimately to the successful outcome that we're trying to achieve with the healthy mix of investment management and financial planning. And that's what this chart shows here, is the typical drift associated with a 60-40 portfolio. 60-40 means 60% stocks, 40% bonds. That's the typical target for your average retiree. You'll be somewhere in that neighborhood. You might fluctuate from 50% stocks to 70% stocks. And You revisit that periodically with your advisor. But you can see here what happens when you don't rebalance at all. If you just look at the green, which is the U.S. growth securities, which would encompass the Magnificent Seven that I touched on a moment ago, that green portion of the portfolio, well, with no rebalancing, it was at 25% in 2019. By the end of 2024, it was at 37%. And that represents an outsized risk for most investors. That's a risk that's inappropriate. So with that consistent rebalancing, we're harvesting those gains, reinvesting them in lower price securities, and creating safer outcomes, more consistent outcomes for our investors. And that was most of what I wanted to convey this quarter, with the one exception of this chart. It really stood out to me, and I've recognized this data over the last few years now, but I haven't had a chance to share it. You all tuning in have heard me comment about we call it a risk premium associated with small cap stocks. And all that means is that if you look back over the history of the market, small caps have a tendency to outperform large caps. And I think that's intuitive, because with the benefit of hindsight, every investor wants to rewind the clock to 2006 and buy Facebook, or 1982 and buy Microsoft, or 1965 and buy Berkshire Hathaway. But good luck picking out those winners if I slide a list of 10,000 small cap companies across the table to you. That's challenging. So what we typically do to capture those returns is buy all of the small caps and just ever so tactically adjust the weights inside of our portfolio so that those smaller cap names are overweighted. Well, this phenomenon that you see here on the slide shows that universe of small cap companies is shifting away from the publicly traded companies that we all have access to towards private companies that, well, because they're private, they're not beholden to some of the regulations imposed by SEC on publicly traded companies, which are expensive and time consuming and onerous. And because they're private, those returns are largely being captured by larger taxable investors. Well, with technology increasing apace, just like everything else in life, it affects the world of finance. And Blackstone, the largest private equity manager in the world, was just in my office yesterday, and we were talking about solutions that allow for exposures to come down market. And when I say down market, we now have the ability to put private equity investments into a typical sized portfolio. So I wanted to point that out. It's a conversation that I want to begin having more and more. You may see this inside of retirement plans, inside of retirement accounts in the future. That's just a little heads up, some vision casting that I'm doing this quarter for our clients. You'll hear more about that in the subsequent quarters. That's my market update for this quarter. I will be back in another 90 days with more charts. Thanks, everybody.